This is Smart Investing with Mike.wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike.wren.
Well, hello there, everybody. You have once again booted up another edition of the Smart Investing Show. It is the podcast where, number one, we try to take the topic of investing and make it easier to understand. Number two, I try to get you good, relevant information on each and every show. And thirdly, we try to be entertaining. And with the entertaining portion is the guy that turns the knobs and, says, hey, man, this didn't work out so well. You need to give me a little bit more money so we can buy a better extension cord, something like that. Anyway, that's Chris.
Sounds just like me.
Yeah, so what's going on, Chris?
Imitation.
Happy March 1st.
Oh, yeah. It is.
Oh, excuse me, December 1st. Just kidding you.
When there's this much snow on the ground, months don't matter
and
anymore.
It's this cold.
Months do not matter.
And I have to shut up now because I've been teasing you, been teasing people. Oh, the snow's fine. And it's like, oh, it's March 1st and it looks kind of like North Dakota out there. I think I'll shut up now. I think I'm pushing the envelope. Yeah, pushing my luck.
It's a frickin' groundhog. As soon as it stuck its head out, it has done nothing but snow.
Yeah.
And I think the groundhog knew. I think they're trying to kill humanity.
I think they probably have that hole electrically wired, and they can make that groundhog come out of that hole pretty quickly anytime.
Shoot him out.
No, he gets a little bit warm. His own little taser. We've tased the groundhog, and now another 6 weeks of winter.
There's his head. Manipulating the weather.
Exactly. It's just the North Dakota version of seeding the clouds.
Oh, there we go.
Tasing a groundhog. So good morning, everybody. Hello. How are you doing out there? On today's show, what are we going to be talking about? Well, we're going to be talking about a little bit about investing. I'm going to be talking about kind of the new age, the edge of groundswell of public thought, public opinion, what I'm dealing with because I'm in the trenches. I am the Jedi Knight on the very cutting edge of what's happening in the world. And there's a lot of things to talk about. I guess first thing is that if we roll back the cameras, roll back history 15 or 20 years ago, I think I was spending most of my time trying to reassure people that I could actually make them money, and number two, that the world would not end. And there is still, I would say, still 2/3, at least 50%, but I'm thinking more like 2/3, maybe 60%, somewhere in there. That's what I spend most of my time doing, is reassuring clients that the world isn't going to end. And that typically involves trying to convince clients that they are not going to die from the stuffy nose that they have right now. Maybe they have a pretty good version of the stomach flu, and they think they're going to die, or they want to die. And I'm there telling them, if it was a female, I'm there holding her hair while she's throwing up in the toilet, telling her she's not going to die. I mean, it's probably a pretty bad analogy, but it is what it is.
You seem to have gotten that analogy pretty quick. Is that
no.
something you want to tell us? Were you in the friend zone a lot in college?
Probably, yeah. I was the one sober person. There were the guys that didn't have real dates. The dates either ended, holding a girl's hair while she threw up, or you ended up with mace in your face. And I was not the guy that every date ended with mace.
I'm just going to say milk really dilutes a lot of the mace when it gets your eyes.
So anyway, yeah, what I mean by that is that human beings, a lot of people in the world have no problem at all when it comes to their money, looking at events that last a month, a week, a day, hours, and basing decisions on that that are going to affect the rest of their lives. To me, I mean, we've all seen good marriages like Chris's. We've all seen bad. I got Chris to look at me with that one.
Good one.
You're laughing pretty good then, but no, I really mean that. That's sincere. So we've all seen good marriages and bad marriages, and I think all of us know that if you see a guy that's in his late 40s, meets a girl from Thailand online, goes and spends a weekend with her, and decides to marry her, bring her back to the United States, I think that all of us are kind of getting that we have a wincing look on our face, like there's a train wreck about to happen. Like, ooh, that's not going to end pretty.
This guy's my hero. He knows what he wants. He's going after it.
Yeah,
this
yeah.
guy's in charge.
We know that based on a weekend of Thai food, if you're going to base your life on a weekend of Thai food, it's probably not going to work out so well. Wouldn't you agree?
I've seen lots of movies to say no. That
Yeah,
they
movies.
turn their life around in 24 hours and everything's fine.
Yeah. Okay. So that's a yes. So we all know that analogy. We can dream up analogies in our head that if we make a long-term decision based on short-term data, it's not going to be a good thing. Relationships are probably the ones that cause us to snicker the most. Maybe because we've all been guilty of having rose-colored glasses with one person in our past or another. And after the 1 week or 2 weeks or 1 month of rose-colored glasses, all of a sudden the glasses were broken. Couldn't find them anywhere. Things looked a lot different.
There's a reason they call it the honeymoon phase.
Yeah.
Because after a while, now it's time. Dishes have to be done. Laundry's got to be clean. The shine's starting to get over.
Jeez, hold on. Let me write these down.
Yeah, they're dishes. You don't just throw them away and buy new ones.
Dear diary, Chris is pretty damn smart.
Chris is usually the one doing the dishes and the laundry.
So, yeah, when it comes to the investment world, I can't tell you. It's not daily because I don't like talking to human beings on a daily basis, so it's weekly. Weekly, I'm here to tell you that I am counseling people to think long-term instead of short-term. And I don't know why it is. I do, but I don't want to get into the depths of it. I don't know all of it, but I have some inkling. So many, many times I'm spending my efforts to try to reassure clients and people thinking about hiring me that the world isn't going to end and that what they're focusing on short term really, really is meaningless in their investment plan. It sure as heck is meaningless in my investment plan. Another thing that I'm dealing with most of the time, where I even have clients that have been working with me sometime, clients that trust me, let's just say, no matter the time, they will still be telling me that, Mike, I'm blankety blank age right now. Okay, that's great. Well, don't you think we should be making some changes? And I said, just because you had another candle on your cake? I don't get that. Please elaborate. Well, I've heard the words.
Boom, boom.
Yeah, the words I've heard in quotation marks. There's no way that even on a podcast that I could tell you my true feelings. The words I've heard. Let me tell you.
Are about as good as I read an article.
No, I read an article means they actually put in some time. But, yeah. So I've heard blah, 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 insert your asinine phrase in here, that, because of this, I should do this. Because I'm older, I should do this. Or, I'll have younger clients saying that, okay, once we hit that goal that we're accumulating for, then what do we do? And I'm looking at them and I'm thinking, wow. Here's what I'm thinking of. Here's what most people don't get. I know the real truth. The real truths are that for the rest of your life, who's ever listening to this podcast, stamps are going to get more expensive. It hasn't occurred in a while. Milk usually gets more expensive. I think what's happened is they've just come out with fancier milk that's really expensive, organic milk. So you can get the other stuff that's still about the same price. It's been for years. But you can get fancier stuff that's way more pricey. What I'm talking about is inflation. Your purchasing power going down unless we do something about it for the rest of your life. I know that we're not always buying a house and so on like that, but I know that you are going to need more income for the rest of your life so that you don't experience your lifestyle going down. I also am a realist where I know that there's a point in somebody's later years to where they really don't experience inflation. They don't experience their purchasing power going down because they're dealing with their health going down. And their health trumps so much else that even if their health care or home care is taking away a lot of their money, it's still another insult to them. It's another insult to their ego, to their spirit, where their health isn't the way they want it, and they're having to spend more money than they thought to keep up with the Joneses or to keep care or to keep healthy. But typically, it's just an additional insult. It's not on the forefront of their mind. So that being said, people are typically thinking, cutting to the chase, that they need to allocate their assets in a way that's better for their age, which is complete bullshit, okay? What it means is that if you own really good investments in businesses, why in the hell are you thinking of changing them because you've heard something or because you're 1 year older? And people they'll trump up something, well, I'm older now. I have a lot less time to recover from a market correction. And it's like, what? Okay, you think that you have one thing you have is less time on the earth. That's what you have. I can guarantee you of that. If you keep talking, it's going to get really short. No, but it's like, I can guarantee you that you're older and you're going to die sooner rather than later. That's the first truth. Happy day. How far do you want to go down this thing? And it's like, well, I'm thinking that, I should make things safer. No, what you should do is keep owning the good investments that got you to this place, and by God, spend more money, because I've never seen a U-Haul behind a hearse, or I've never seen somebody's ashes delivered in a brand new Bentley. Doesn't happen. A lot of this stuff you can't take with you. So one thing is you being safe is only going to hurt your heirs. Okay, thinking that you're going to be safe. You're changing your investments from what's made you all this money over the time. I think since I've gone past this birthday, I want to give the big finger to my heirs. And I just, so I can.
Sometimes we do, though. Let's face it.
Yeah. But there's reasons. This is not the right reason where I think just because I'm older, I want to tell them to go to hell. No, it's just, I want to, do you see what I mean? Is that there's all of these culturally accepted norms where I've heard this or you got to do that when it's this age, and they are all wrong, okay? They are wrong. What I base it on is I base your portfolio on your income needs, okay? If your income needs are become lower, I'm going to ask you, why are they lower? Why are you waiting another year to take this trip to wherever? Because you're just going to be another year older when you do it. So why don't you do it now? That way, Mother Nature has the less opportunity to screw with you between now and then, so you can actually get on and off the airplane under your own power, or you can drive yourself instead of being driven in some ambulance or whatever. I'm being kind of graphic, but yeah, I see it happen far, far too often. That right when you think, if you're listening to this podcast and you're one of those that's thinking that, okay, I'm thinking that I should, make my portfolio safer, by God, then let me put something in your mind that says, I think that you should spend more money. Or I think that if it's not spending money, I think that you should think of, rather than be safer, think of your bucket list. Think of the things that you truly, truly, truly want to do or get done before you're not on this earth anymore. You focusing on that will clear your mind. All of a sudden, that's much more real than any version of safety or aggressiveness in your portfolio. All of a sudden, it's real stuff that's close and dear to your heart. Then we'll move on from there, because what's more likely is that maybe You shouldn't be moving some of your investments from owning really good companies to bonds. Maybe you should just be selling some of it, putting that money in your pocket, and going to spend it to do something. Maybe to go on a trip. Maybe to do something at the house that you're at. Maybe to do something for one of your kids or a loved one while you're alive instead of when you're dead. Because when you're dead, I don't know. I don't think you're going to know what's going on. I don't think you're going to see with your own eyes the ability that you have to, show more love for somebody. Okay? Whether it's, in material goods or non-material goods. Also, when I'm speaking of errors and so on, your money can do infinite good. I'd never lose sight of that. Somebody's portfolio can grow over generations. It just doesn't have to stop with one person. It's actually pretty easy to get it to grow multi-generationally with just a little bit of forethought. My competitors call that planning. They like to charge for it. I don't. It's what you talk about, with clients when you know them a long time and you're sitting with them and visiting. You really, really get to know somebody. That's where forethought really comes in, where maybe your portfolio is going to enable you to be showing care and love for someone when you're not even here anymore. That's pretty powerful. So that's, rather than focusing on, I should do this or I've heard that, let's turn the situation around and figure out what else you truly want to do while you're here on earth. That then, you see how it's much more powerful? It's real. It's boom. Oh, yeah. That's all of a sudden it focuses the mind over here, and we can get to reality instead of dealing with whatever they've heard on the radio or whatever their neighbor has told them.
And you can help with that.
Yeah.
Okay. So Scarlett Johansson's lawyer has really been mean to me lately, and I'm finding it hard to have her contact me. So maybe after the show is off the air thing, you can contact her.
Yeah, hold on. What is Chris talking about? Is there alcohol
there's
in that
bucket
little
list?
Oh,
I'm just trying to fulfill my bucket list, and I'm not climbing Yosemite. All right.
Yeah. First advice is block your number.
Oh, dang it.
I think the spies call them get a burn phone.
A burn phone. A burner.
Whatever, you just throw it away. I think, right?
I can't afford a burner phone. I can't just afford to just go throwing phones away.
Next portion I want to get to as far as investing is, I started this out that that's like 60% of the people are what we just talked about. There's kind of a cutting edge version of the public now. Let's say 30, 40% of the public. They've kind of realized that the world isn't going to end, but then they have drank enough of the Kool-Aid that says index funds are the way to the world. And frankly, there's some really, really good advisors in my industry that have decided that they finally realize over the last 15, 20 years that, by God, no, the world's not going to end. They should just be making sure that their clients stick with their investments and that they put them all in like 3 or 4 different mutual funds, and then they rebalance those mutual funds once a year, and they make sure that those clients behave correctly and don't panic out, and they put the client's best interests in, like they always have and probably and will always will. Great. That's a good advisor. But to me, you're leaving a lot of really good growth on the table. And I've talked about it on the show before. Why do I feel that way? Well, it's because when you own a mutual fund or any sort of a package product, your performance is going to be muted. Okay, that's a fact. I don't think you're going to make as much as everybody says you're going to make. Number 2, my industry says that it's a safe way to do it, that it's insulating you from some of the good performance. But they say, what you get with that, you get professional money management, and it's insulating you from a lot of the downturn. Okay, well, I'm here to tell you that I've been through several down and up markets dealing with human beings over almost 30 years. The amount of the down really doesn't matter because people are going to find a way to have their own little panicky thing.
Well, everybody always needs something to worry about.
Yeah.
All the time.
So it doesn't matter if the market's down 40% or if it's down 10. I'm still dealing with the same sort of emotions. The only thing that makes it different is if the market's down 40%, I'm having to deal with the majority of people that know my name worrying. Okay? That's all that it does, is it increases the amount of people trying to freak out. It doesn't increase the amount that they are freaking out. Okay? So it increases the masses. Doesn't increase how much they're freaking. Okay? They freak as much about being down 12% or as much about being down 30%. So the mutual fund package product industry, when they say the words, we will insulate you more on the downturn, if you're in the middle of a downturn, or if you've just been through one and you can tell people, hey, the indexes were down, 20%, your portfolio only went down 10%. Let me tell you, this is a truth. Nobody gives a shit. They are still panicking and crapping their pants. They're pissed off. They're scared, and nobody cares. You can hold up your little pie chart that says, hey, our volatility was less. Nobody cares. People are still panicking and pissed off. Maybe not to a huge degree, but that is just a truth. So that's the first thing. So on the one side of the package product equation, they say, oh, the downturns are easier to endure. No, they're not. Maybe if you've got 20 years in that package product, if you've stayed with it that long, which nobody ever does, maybe over that kind of long-term period, you can be happy with it. But that so rarely happens, it's not even worth talking about. Here's the other problem. So the insulating you on the downside, emotionally, you don't feel that. You don't really realize the benefit because emotionally, a 12% downturn is just as painful as a 24%. Here's the other thing. And you can think that that's wrong, but it's not. When when their portfolio goes down 10, 12%, if you add another 5 or 6 in there, it's the same level of emotions. Okay, the fervor's just right there. So here's the other thing the package products do. They insulate you from performance. So happy day, your downturn, you still feel all of the emotional pain that everybody else does. And guess what? On the upturn, when you're making money, you get to feel less of that too. Awesome. So you get to feel just as bad as everybody else when your portfolio goes down. And guess what? We're insulating you on the upside too. So you get less gain when it goes up. God, that sounds awesome. So when things are actually going well, they kind of never go well enough for you to have this feeling that you're on the right path. Think about that. You don't quite get the performance where you're thinking on the right path. And that right there is the chink in the armor of my industry. You have to give an investor some performance at some point, and you have to give that investor some consistency. You have to be somewhat predictable in your behavior with the investor. I have to be somewhat predictable with my clients, and I have to be consistent with my clients. That earns some trust. So a lot of my competitors, I think, are that way. They're probably giving their clients predictability and some consistency. But if they don't get performance, they're always going to be second guessing. I wonder what else there is. Because, yeah, John Smith is giving me, he's predictable, he's consistent, he's honest, I trust him, but I'm just not feeling it. When the market's going up, my portfolio isn't going up as much as I think that it should. What's going on?
I think that's the way also, like if you're at your job and you're just always doing, well, how come I'm never noticed,
Yeah.
I'm doing fine work. And
You need something positive to happen to you with your plan. So you want to continue to be in the plan. Okay? I feel, and it's my own opinion, that the package products in the world don't give people enough performance when things are going well, that they ever feel strongly enough that they're on the right plan. So they continuously think about changing that plan. and then it's the snowball's ride to hell, that they are thinking that there's something else better. There's something else better to do. I have a client that she's been my client for years, and she's older, so she has, I think, a significant other in her life where they're not married, but a significant other that she trusts. And they had called on the phone. She had wanted to take out some of her investments to make some sort of a land investment in some ski resort area. And then, on top of that, they were thinking about taking out some additional money to make some sort of a cannabis investment up in Canada. And I told them, and I said, why? I said, are you trying to get better performance than what you have now? Because if you want better performance that you have now, I didn't realize that you are that irrational or greedy. Where do you think that you, and I'm not going to use the returns on the radio that she is getting, because nobody listening to the podcast would believe the sorts of double-digit returns that she's garnered from owning these really good companies for long periods of time. We'll just say that they're in the low, middle, and high double digits, and we're talking for more than a decade. So when that happens for that period of time, what the hell else do you want? And I actually told her and her significant other, I said, I can understand the land thing if you want to do something different. I highly doubt if you're going to meet the performance, but I know where my place is. It's absolutely your money. You are the boss. I'm only the Joint Chief of Staff. So if you tell me to do something, I'm going to do it. I said, but respectfully, you talking about your cannabis investment up in Canada, you're going to get screwed. That's just sounds like 100% screw job to me. I said, one of the companies that you already own, Altria, has made significant investments in the cannabis industry, and there's CBD oils and all of that. But the way that you're going about it, you're going to get screwed. I said, I'm comfortable making this blanket statement. I've been doing this long enough. And she says, well, we're not going to do that then. Then we'll just concentrate on the land deal. And you know what happened is all of a sudden her experience with me of earning money trumped the love and it trumped the significant other's advice on this topic. All of a sudden, it started to sink in that it's like, oh, significant other good, significant other very good, significant other just as much experience as Mike ran on investing, no way in hell. So we're going to go back across that line again. We're not going to step over that line.
I'm just going to take a shot in the dark, but I'm pretty sure your name was probably mentioned a few times at their house.
Well, they were both on the phone, and I said, I don't want to be causing waves, but I said I would feel guilty if I didn't mention something. You're not causing any waves. She was the one saying that, not the which is all that matters to me. Whoever the client is, that's so. Anyway, where was I going with this? Is that there's a whole bunch of folks out there in my industry that have finally caught on to focus more on your behavior, you're the investor behavior, but they're using all these packaged products. Okay, here's my issue with that, and I said this on last week's podcast. If you're going to behave appropriately, then I can do some really cool things. We can do some really, really good things together. If you're going to behave appropriately, we can own the best companies on planet Earth, and we can own them for the long haul. And I have a feeling that you're going to be impressed with the performance. Not packaged products. I'm talking individual companies. Again, my industry is the one that says diversify. You should own all of this stuff. But yet again, you have all of the people that have, become extraordinarily wealthy in the industry. Last time that I thought about this, Southwest Airlines, Herb Kelleher, the founder of Southwest, he wasn't trying to sell coffee to people. He was trying to sell airplane tickets. And he concentrated on that. That's all he did. Ray Kroc, hamburgers. Okay? I forget his name right now, but the founder of Starbucks, same thing. Concentrating on coffee. Not concentrating on French fries. Not concentrating on cell phones. That's all they did. So what I'm talking is if you want to get wealthy, there has to be focus. You can't diversify into wealthiness. Diversification is for safety. It's not for growth. Diversification is two things. It's for people who don't know what they're doing, and it's also for people like me that know that they can't tell the future, that aren't right all the time. But it's not the sole goal of my industry. It seems like that's their goal, to diversify the bejesus out of you. That's not my goal. My goal is to make you money. So a lot of times, if you're going to behave correctly, my opinion is you own a good basket of individual companies. Mathematically, you can look it up on the internet. You only need to own a very small number of different industries before you're truly, mathematically and algorithms, diversified like a packaged product. Truly, you'll be good to go. But when you own that basket of individual companies, number one, you get to know what you own. Number two, they pay consistent dividends typically, and they raise their dividends on a yearly basis. It's not guaranteed, but look at the history of these companies. Look at what they've done. Pick any company that you want that's been around for 15 or 20 years. Take a look at their dividend history. So if you're going to behave correctly, that's what I want to own. I don't want to own a packaged product. And then you'll have my industry, well, you're not diversified. Yes, I am. Then they say, well, what about the market downturn? You'll have 100% of your clients' money in that basket of companies. And I say, no, I won't. What else I'll own is cash. Because especially if a client is becoming close to the income days, I want a year to 2 years of income in cash. There's your anchor. There's your safety zone. You don't need all of these different packaged products to accomplish just what having a couple years of income in cash will do for you. That cures a lot of ills. So if you can, my position is if we can plan for that and you're going to behave correctly and not panic out, well, then let's just own the really, really good companies out there and own them for forever. Like Warren Buffett says. It's funny how he runs his Berkshire Hathaway one way, but when he talks about the public, he tells the public to just invest in index funds. That's how come it really pisses me off that he's hypocritical and no one calls him on it because he's old and because he looks like everybody's grandpa and everybody thinks, oh, he's just some benevolent, nice guy. To hell he is. He is a capitalist. He is out there to make the most money possible. What do you think he'd rather do? Go fishing with grandkids or make another $1 billion by an awesome investment? Okay, I'm going to choose number two. I can't imagine that guy in a fishing vest, dealing with fish guts and everybody out in his hip waders and saying, isn't this awesome? He would rather be making money. Okay, that's the reality of it. I'm okay with that. He's a nice guy, but he's not Santa. People treat him like he's Santa Claus. I didn't get my present from him.
I did not know when I walked in here today, we'd be taking him down. That's right.
I'm not taking him down. He's awesome. It's just that he's not Santa. It's like, oh, he said this, he said that. Oh, if he told you to jump off a bridge, would you do it? Come on, people.
Well, how much money is he giving me?
So anyway, my industry's finally getting the hang of it that people are irrational and people behave bad, so they're kind of concentrating on that. And what I'm here to tell you is that for the last 15 years, Chris and I have been ahead of the curve. We've already been talking about how investor behavior is the main factor in how much money you're going to make. I'm again ahead of the curve by another 2 decades. What that means is my industry's finally getting caught up a little bit on the psychology of investing behavior. And they haven't taken it to the next step. Once they take it to the next step and they realize that if you're going to behave correctly anyway, they're going to realize that you're kind of an idiot if you own an index fund. If you're going to behave correctly, is the index going to give you the exact same sorts of dividend increases that you get from, let's say, 2 or 3 different telecommunications companies? I'll even put them out there for example purposes. Compare it to Cisco, to Verizon, to Qualcomm. In the pharmaceutical industry, Abbott Labs, AbbVie, Bristol Myers, Merck, Pfizer, Sanofi, GlaxoSmithKline, Cardinal Health, Novartis, Gilead Sciences. If you go to the chemical industry, Dow and DuPont, RPM International, Sherwin-Williams. If you go to the oil industry, if you go to ExxonMobil or Royal Dutch Shell or British Petroleum, the food industry, everything from Campbell's Soup to Starbucks to Procter & Gamble. If you go to, the utilities industry, guess what I missed out? A high tech, Microsoft, Intel, the two Hewlett-Packards, machinery companies, Cummins, Caterpillar, Parker Hannifin, railroads, CSX International. Look at those companies. Look at the dividends that they've paid for the last 20 years. Do you get those types of dividends with your packaged products? The answer is going to be no. So, again, I don't mind saying this because the proof is in the pudding and the performance. For almost 20 years, Chris and I have been telling you, your behavior is what's wrong. It's not your investment. It's you. It's the person in the mirror. So once you get square with the person in the mirror, then you don't need all of this baby stuff that my industry deals in. You can just own the really good companies. And if you want to be safer, put a lot of money in cash to counterweight you owning nothing but individual companies. Guess what? There's no expense to owning the cash other than your loss of growth. It's going to be eroded because of purchasing power. But who cares? 2 years of income in cash, that's not all that much to not be earning a ton of interest on. You know what I mean? It gives you so much safety that the fact that you're not making anything on it, I think, is a good trade-off. But again, a lot of people out there, I've got a lot of money in cash. I wish I could be earning something on it. Well, how does that cash make you feel? Well, pretty good. It makes me feel comfortable. Then don't screw with it, idiot. Leave it there. The one thing that's making you feel comfortable, well, but I'm making more money over here. I said, yeah, you are making more money over here in these companies. But guess what? What if they go down? How's that going to make you feel if you don't have that same amount of cash out there? Well, I might feel kind of shitty. Well, then don't do it. Here's your answer. I might feel kind of scared. I might feel naked and afraid. Well, then that's a cable show. Don't feel that way, So so again, that's me telling you that, again, Chris and I, if you're listening to the podcast, you just are at least at a decade and a half ahead of my industry and a decade and a half ahead of the journalists out there. Listen to Charlie Munger. Listen to Warren Buffett. They're going to be saying the same things that I'm telling you in a much more eloquent way because they're older. But, Charlie Munger, he was saying he's got a pile on his desk that he calls it the too hard pile, too hard to understand. He puts almost everything in that pile, he said.
I have a stack of bills like that.
Yeah, well, and he says if I just put it in the too hard pile, then he says when I actually get something that I understand and I know to make a decision, I make it. And then he adds something else. He says, and I act swiftly on that decision. So he's just concentrating on what he's comfortable with, and everything else he dismisses. So, that's pretty focused thought. That focused thought will pay huge dividends. You just have to behave correctly and not freak out. So we're getting close to the end of this podcast. For the compliance people and the attorneys out there, I mentioned tons of companies just now.
All offhand with no notes, by the way.
Yeah, no notes at all. So those types of companies that I mentioned, none of them do I want you to run out and invest in. They are just for purposes of discussion. They pay dividends. Go look them up. Look at what the dividend was a decade ago and look at what it is today. It'll give you somewhat of an indication of how they manage their dividend and how profitable they are, because if they're paying you a dividend, means the company, guess what? Profitable. And they're sharing some of that profit with you. And that's something that kind of doesn't happen when you own packaged products, mutual fund, index funds, annuities, and all of that stuff. All of those things are products sold to you under the guise that they will help you behave better, that you take this pill and it'll make it much easier for you to lose weight. Unless that pill is, methamphetamine, that raises your heart rate, causes your teeth to fall out, and ultimately you die or become in jail from it. Unless it's that pill, I don't think any of those other pills will help you lose weight.
That'll make you lose weight, yeah. I could use either some prison time or like Survivor Island. I think that's my desperate losing weight thing right now.
Yeah, so we know intuitively that when they say that if you take this drug, it's going to make you look better, get in shape, and lose weight without any effort. We know that that's BS.
Well, now they did have that James Bond pill.
What's that?
There was some kind of pill that it was like a Viagra thing or something like that, but they actually found that the side effects made you more kind of like narcissistic and you like to gamble and womanize. Google it. It was unreal.
Really?
And I can't find that pill anywhere now.
So you know that if somebody has that, if they're telling you that story, you know that it's not true. They're just trying to sell you that drug. My industry, think of it as the same way. If they're trying to sell you an investment product that's going to make it easier for you to not panic, that's not true. You have to fix you first. You panicking, you behaving correctly, that's where the rubber meets the road. If we can get you to behave correctly, then you don't have to own all of these packaged products. We can own the really good investments that America's wealth is built upon, and you can own them for the long haul. This has been the show Smart Investing. I'm Mike Wren, your host as always. The producer's Chris on the other side of the table. Anything for anybody else out there, Chris?
Yeah, just remember to go to smartinvestingshow.com if you have any questions, because that has all the addresses, phone numbers, and links to the Facebook and YouTubes.
Okay, thank you very much for listening.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.